stock market isn't just for the rich. Here's how you can start, even with $100. We'll go over everything you need to know as an absolute beginner, from important terms to the best investment options, and how you can actually turn your small capital into real wealth. Stick to the end, as we have a quick, beginner-friendly investment plan to get you started. Okay, right off the bat, what are stocks? A stock, also called equity, is a security that represents ownership of a fraction of a company or corporation. Stock is usually made up of individual units of ownership known as shares. So, in simpler terms, a stock is a tiny piece of a company that you can own. For example, let's say you have a friend, we'll call him James, who owns a popular coffee shop in your area. To accommodate his growing business, he wants to expand his shop, but there's only one problem. He doesn't have the money for it. So, he reaches out to you asking if you can buy a small part of his business. A share, he says, will cost you $100. So, you decide to invest $2,000. That will give you 20 shares. That's your stock. You are what's called a shareholder and own a small part of James's coffee shop. If, say, in 1 year, the value of one share shoots to $150, then the value of your stock also goes up to $3,000, and you can make 50% profit from selling it. Think of this as the basic workings of the stock market. Huge companies looking for investors apply to be listed on stock exchanges, which is called an IPO, or going public. Then investors come to shop around and buy stocks that they think will do well in the short or long term. As is with any market, stock prices fluctuate based on, among other factors, demand and supply. Apart from stocks, there are other assets you can invest in the stock market, one of which is bonds. Unlike a stock, where you're giving a company money in exchange for ownership, a bond is simply a loan. You loan a company or government money with the promise to pay back later with, of course, interest. That said, when it comes to investing, there's something called diversification. Basically, you want to spread out your risk, just in case one stock plummets along with all your money. Many seasoned investors can afford to buy different stocks and bonds to diversify their portfolios. However, as a beginner, you probably don't have tens of thousands to spare. This is where ETFs and mutual funds come in. What are ETFs? An ETF, which stands for Exchange Traded Fund, is a type of security that holds a collection of stocks, bonds, or other securities and trades as a single unit, much like a stock. Think of it like a fruit basket that, instead of having just apples, also has bananas, oranges, strawberries, and so on. When you buy a share of an ETF, you're essentially buying tiny pieces of all the companies in that ETF. So, if it is an ETF of major tech corporations, where the share price is $100 for instance, you'll have a tiny piece of Apple, Meta, Microsoft, Alphabet, and so on for just $100. Is a mutual fund the same? A mutual fund also gives you diversity by allowing you to spread out your investment capital. However, in this case, you're putting your money into a fund along with other investors, and an investment manager decides what stocks and bonds to invest in. Given that a mutual fund is actively managed by a professional, it is more expensive than an ETF. Up to this point, we've talked about investment vehicles that you can invest in the stock market. Now the question is, how do you buy them? The stock market isn't a store you can walk into, pick what you want, pay, and leave. Investment platforms. To invest in the stock market, you need an investment platform, commonly known as a broker or brokerage. Think of it like an online store, but instead of products, it offers stocks, bonds, or funds. The good news is that these platforms are pretty simple to use. You just set up an account with your details, link it to your bank account, fund it, and you can start shopping, aka buying and selling securities. For global options, you can check out Robinhood, eToro, Interactive Brokers, IBKR, and Revolut. As for the Indian stock market, Zerodha, GrowW, and Upstocks are great options. Now, as a beginner, you'll have some initial excitement. You want to see your money 2 times by end of the month. Unfortunately, this isn't how the stock market works or how you will build wealth. Compound interest and building long-term wealth. The secret to building wealth is in a concept known as compound interest. In simple terms, Compound interest is the interest you earn on interest. When you invest, say, $1,000, and at the end of the year, your investment earns 10%, you now have $1,100. If you keep that money invested, then the following year, not only will your $1,000 earn another 10%, but your $100 interest will also earn interest. So, instead of earning $100 for year 2, you'll earn $110. As long as you stay invested, compound interest will keep accumulating like a snowball rolling downhill. Ultimately, compound interest accelerates long-term wealth growth. Fun fact, the rule of 72 tells you how many years it will take for your investment to double in value with compound interest. Simply divide 72 by the percentage annual interest rate. Now, if you've reached this point in the video, congratulations, because we've got a quick and simple investing plan to get you started. Set your goal. Do you want to buy a home, retire early, pay your kids' college, pick a brokerage, and open an account? When making your choice, consider things like the asset mix, fees, and minimum account balance. Start small and know your risk. Buy your first investment, concentrating on well-known ETFs first as you learn the ropes. So, are you ready to start investing? Let me know your pick in the comments. And if you enjoy investment tips like these, subscribe to Global Money Mindset and turn on your notifications for more nuggets.